All right, so obviously the name of this panel is where do we go from here, / could it happen again? And I think probably yes is the answer we've heard throughout the day today. Probably not in the same form, though. And for this panel, we're very honored to have moderating Bill Boulding, who's a distinguished professor here, as well as the dean at the Fuqua School of Business. So thank you guys for being here today.
Thank you all so much. The really distinguished people are to my left, and so they need very little introduction, but Rick Wagner, in addition to being the former chair and CEO of General Motors, it's important to note that he was a former chair of the Business School Board, in addition to the chair of the Board of Trustees. Gerald Hassell, in addition to being the former chair and CEO of Bank of New York Mellon, is the former Business School Board chair, in addition to being a distinguished trustee. And so Joe is also deeply connected to Duke as a PhD alum. And I don't know, given you're in this company, what your future holds, but
he's the brains.
Doing the work.
So Joe is the chief economist at Vanguard, but he also is involved in the management side in terms of asset allocation, and in particular the fixed income group. Mm-hmm. So anyway, we have a very distinguished group and played different roles during the crisis. And so I thought I'd just start off to kind of level set around where we go from here, to go back in time and to ask each of you to talk about the moments during the crisis that were scariest, most impactful for you. So Rick, do you want to kick it off?
Yeah, thanks, Bill, and thanks to whoever got the picture of me from 25 years ago. You can see the impact of going through one of those financial crises when you look at that picture and see me now. Obviously, GM was in the headlines quite a bit during this crisis period for an interesting reason, which hasn't been discussed as much today among the great work the panels have done, which was the ramifications of the so-called financial crisis on the liquidity for everybody else, and the impact not just on the bank's ability to lend, but more importantly, what it did to the commercial paper market, general corporate bond issuance capability, even the ability to issue corporate equity. So I remember distinctly at the end of '07, we had just completed a historic agreement with the United Auto Workers, which basically addressed what had been a tremendous issue of post-retiree health care, where we had spent $100 billion the prior 15 years and had finally come to an agreement with them on how to handle that, which would take it out of our, drain on our current cash flow to free up money for investing in the auto business. And our stock price was at a high that it's been for a long time. And then it seemed like about 5 minutes later, the general economy began to weaken. And I remember distinctly going into our beginning of the next year board meeting, and the board members were setting our budget for the year, and they were saying, what kind of market do you foresee? The auto market had been running between 16, 17 million units. And I said, well, if you go, it went back, maybe our economist said sort of worst case on a down cycle would be 14 million units. If you went back to the early 90s, we went down to 12.5 million units. And someone said, what if you got to 12.5 million units? I said, it's going to be tough sledding. And I was thinking from the perspective of operating earnings and operating cash and funding the capital expenditures we had. Well, obviously, eventually the market got much worse to 9.5 million units. And we did, as a result of that, have significant operating losses in the business. But by far the bigger problem we had was the inability to access capital markets for liquidity. In our business, for every unit less we produced, we lose about $20,000 of working capital at that point. So as we were rapidly reducing production rates, we were not only having losses due to the operations losing money, but despite cost-cutting efforts, but the toughest part was we had this reduction in our working capital, which over time would have come to about $25 billion, and we increasingly had difficulty finding sources to fund that. I remember distinctly we were looking at a capital raise, an equity raise, which was tough at the time because it would have been quite dilutive and equity prices low. And every time we talked to the bankers, it would be, we can get you X billion at Y price, and then the next time we talked to them a week later, we can get you X minus 2 billion at Y plus 2%, and it became a non-viable solution. So we obviously had a tough period as we went through there, and I guess my most vivid memory is going to Congress, and I thought it would be good to go after the banks, because nobody likes banks, and Congress says, hey, we're going to give the money to the banks instead of these poor auto guys. We employ zillions of people. We pay health care to 1 million people. They're probably going to be okay with us, and I was wrong on that. Also didn't realize bankers can fly to Washington. Auto companies execs are supposed to drive to Washington, I guess. So anyway, we got into that, and that was obviously tough, and all worked out okay in the end, but it was pretty tough sledding for a pretty good while.
Okay. Gerald?
So maybe giving a little bit of context, because most of you probably don't know very much, if anything, about Bank of New York Mellon. But our main business model was providing the infrastructure for how all the capital markets works. And so essentially all of the market participants, whether it's the buy side, the sell side, the intermediaries, and in some cases the shadow banking market, utilized our infrastructure to buy and sell securities, clear trades, value the trades, et cetera, et cetera. So it's our largest business, and so by definition, all of the market participants that you've heard from today were either our clients or in some cases our regulators. And so for us, it was really an interesting time, because while we were a relatively conservative institution and didn't make loans and didn't buy securities and didn't do all the things that most of the financial institutions did, our clients did do those things, and we sat in the middle. And sitting in the middle, we were supposedly acting as an agent between people who wanted to invest money and people who wanted to borrow money. And that being said, as the crisis got worse and worse, people looked to us to provide some of that liquidity or some of that support, which wasn't our model to do so. So some of the most acute points that I can recall, and there were many, many along the timeline that you've seen earlier today. For us, it started really in early 2007. And we started to see a change in the value of housing prices, and therefore some of the changes in the most easily marked securities associated with the housing marketplace. But we also came to realize more and more, because we were helping to finance the positions of the broker-dealers and the market makers, that you had a lot of subprime securities, asset-backed securities, CDO squared securities, securities that were incredibly difficult to price and therefore mark. And as a result, we started to see some concerns on the part of liquidity providers to support the positions of these market makers or financial institutions. So in the summer of 2007, this was before Bear Stearns, before Lehman Brothers, et cetera, the mortgage banking market in general was starting to feel some of these pressures. And the largest one at the time, non-bank one, was Countrywide Mortgage. Many of you may remember Countrywide Mortgage. They were a large client of ours. We were their, quote, clearing agent, which meant that all of the positions that they held on their balance sheet, they had to fund. And like most financial institutions at the time, they funded it through the, quote, wholesale funding market overnight. So they borrowed every single night a certain amount of money against long securities. They were being marked down in value and price, not rapidly enough, but they were starting to be marked down in price. Countrywide itself did a couple of very dumb things, and it concerned us to the point where we thought that the investors who were financing Countrywide Mortgage in the summer of 2007 may not show up the next day to refinance those securities. And if they didn't show up to finance those securities, what was Countrywide going to do, or what were we going to do? And so we started to think very, very carefully about the marks or the margins that were being placed against those securities, and started to really ramp up the requirements of someone like Countrywide to put more collateral up or more cash up to support the securities that they were holding on their balance sheet. And that was just the beginning. And we actually called the New York Fed and said, we think it's more than just Countrywide. There are others that are out there that are very similar in the look and feel. And for us, that was kind of the beginning of what became the, quote, financial crisis. And it went on through 2007 with very little change, virtually no change to the marketplace or market activity. In March of 2008, obviously Bear Stearns became, the poster child for the beginning of the remark or the meltdown of different financial institutions. We actually started to see some of the behavior change on the part of investors and the part of people who would leave deposits with Bear Stearns start to be concerned about them as a counterparty. The cash that they would leave with Bear Stearns started to move over to institutions like us, and not in $1 and $2 at a time and billions at a time. So we could start to see that Bear Stearns was going to have a liquidity problem before Bear Stearns knew they had a liquidity problem, because the cash was moving away from Bear Stearns to, quote, safer institutions. So it was not a big surprise to us to see Bear Stearns run out of cash, run out of liquidity to finance their positions. And when you start to lose liquidity, you can't sell your securities fast enough into a declining marketplace. It's how do you grab that falling knife and not cut yourself to death? And so they couldn't sell securities fast enough to support the lack of liquidity that they were having. So Bear Stearns became another big inflection point, in March of 2008, and of course throughout 2008, more and more securities were being marked differently, derivatives were being marked differently, credit default swaps were being marked differently, and as a result, more and more collateral or cash was having to be placed to support these positions. And then we finally reached Lehman Brothers. Lehman Brothers was, clearly a major event. And having Lehman Brothers go down so quickly, and most people forget, Lehman Brothers was still an investment grade security at the time that they went under. So the Lehman paper that was held by money market funds, by institutions, by sovereign wealth funds, by securities lending programs was still an acceptable security until the day they went under. The day they went under, you had several $100 billion worth of paper that was not worth nearly what it was the day before. And so therefore, the liquidity associated with funding that walked away. And it had a profound impact on things like money market funds, the commercial paper marketplace, et cetera, et cetera. And so shortly thereafter, you started to see a run on money market funds. The reserve fund, quote, broke the buck, I think a week after Lehman Brothers. And so that caused the whole marketplace to lose confidence in, is anything worth what it's stated to be worth? And so it had a contagion effect across all asset classes, all institutions, and not just in the US, around the world. So it became a very scary moment when even money market funds weren't deemed to be worth $1. And so as a result, people went to cash and treasuries. Now the Bank of New York Mellon, fortunately, was considered a safe institution. We got more cash than we could possibly deal with. But we didn't want to make the mistake of lending out that cash against the falling prices of securities or failing institutions. And so that was kind of what we were dealing with, was watching our clients go through enormous stress, trying to deal with falling prices and illiquidity. And it wasn't just illiquidity in their own institution, it was across the entire spectrum.
Joe?
My experience, again, it's going back, I can't believe it's been 10 years. As someone said once, it's a fog of war. It feels like that in many ways. My experience at Vanguard, for those of you who may or may not know Vanguard, so we provide mutual funds and exchange-traded funds to roughly 20 million clients around the world, many of them in the US. So providing equity funds or stock funds, bond funds, and then importantly, money market funds. And one of my experience being affiliated and being part of the senior portfolio management team, one of the biggest, our overarching mission is to help investors be successful. And it's not our money. It's not Vanguard's money. We have over $5 trillion in assets. It's all of our clients' money that we pool and just oversee as custodians of capital. And I'll never forget in 2007, as Gerald was mentioning, the pressures we were seeing, particularly in the parts of the mortgage market. And we have the portfolio management team, we have counterparties that we have internal credit analysts whose job is to assess the financial stability of counterparties that we may engage with for financial transactions. And again, these are short-dated instruments in the money market vehicle, right? So you're talking about commercial paper, you're talking about discount notes, Freddie and Fannie securities, and besides Treasury bills. And throughout 2007, that list, which used to be over 20 institutions, we were already pruning down to a short handful. And so even going into 2008, we were significantly concerned. So I have two vivid memories. One is having daily meetings on the performance of the fixed income market and the money market, which gave me an important lens in terms of the gravity of the economic situation that was already unraveling. We tend to be more pessimistic than I'd say the average economic assessment, but we were too optimistic because the projections kept coming in below expectations. And we had somewhat of a special lens because of the short-term funding markets. And so I'll never forget having those conversations. I remember being on the trading floor. I sat next to the head of our global head of fixed income. And I will not name the financial institution, but because we had to cut counterparty exposure, effectively the conversation went, well, you've just effectively insured our demise. Right. But the response is we have a fiduciary responsibility to protect our shareholders. And so that was that dynamic. We were turning more money away than we were seeing flee the funds because of the perception. Again, the perception becomes reality in a financial crisis. A lot of institutional investors in particular saw the yield on our portfolio and the safety. So we were turning away millions upon millions daily, because that quote-unquote hot money would have actually lowered the yield on all the existing shareholders if you had a money market fund. So that was my one recollection. And I remember I was going to take the stage in DC on our own institutional client event on the Monday after Lehman failed. And the title of my presentation was A View into the Future, the U.S. in 2030. And I said, if we can get through the next 30 days, I'll be pretty happy. In fact, I remember many meeting participants as I'm speaking. You try not to take this personally. Imagine half the room leaving right now as we're talking, because that's what was happening as events were unfolding. It was a very serious consideration. And my only other memory was not on the financial. So that was from a financial risk-taking and being part of the financial markets perspective. The other one was just interfacing what I would call just everyday investors, whether they had $1 million with Vanguard or $1,000. And we tend to do, like many firms, you'll have, like, say, webcasts or so forth for individual investors. And I recall doing one in early 2008, and knowing how many investors we have, you would say, just for sake of argument, you may get in a write-in. You have the option to email in a response or a question to the session. Generally, I would get say 15 or 20,000. That may sound like a lot, but we have 20 million investors, so it's actually really, really small. I remember in those instances, we got at the one point. I remember getting the Excel spreadsheet could handle it. It was over 500,000, and the most common sentence or question was, "I am X years old," so all the X's varied. "What do I do?" And so that just hit me. I mean, I'm living it in mortgage, but that's when it hit home to me, because I not only had friends, not only am I saying that, but having friends, but seeing individual investors of all ages and stripes having those questions. So that was also what stuck out for me, Bill. So
it seems to me the money the two of you were turning away, you could have just sent it to Rick.
Would have been no problem, guys.
So. Okay, so we're supposed to talk about where do we go from here. In order to do that, I think we need to understand where here is. And so I'm curious to get the insights from the three of you about the unintended consequences of the actions that were taken to both solve the crisis and also to prevent a future crisis. So what are some of those things that we now face that may not have been intentional, but we have to live with them? Joe, you want to kick us off? Or?
Well, I mean, I think in many ways, I hope that this is not going to come across as naive or Pollyannish. I think the financial system, generally speaking, I think is stronger today than it was in the past. I mean, I think there's more capital provisioning. I think you know, there's been a greater appreciation of being more both targeted as well as willing to do whatever it takes. Now, some may not agree with that. But I do take issues of what I would call, forgive me, the Old Testament response to a financial crisis, where you can let the fire rage out of control, and you not only take out the underbrush, you also take out, you know, healthy living trees. And so I think there's been some improvements. That said, I think we are vulnerable globally to pockets of illiquidity. There's a great deal of capital in the world, and so I don't know if we need necessarily more regulation. I think there's some pockets you could use potentially better regulation. I think we have more transparency on financial instruments. There's been some improvement earlier today. We heard around the derivatives and clearinghouses, so I think we're a little bit stronger than where we were in 2008. You know, will there be another financial crisis? Of course. I don't think it'll be tomorrow. Yeah. I'll turn it over to someone else.
Well, I would, you know, echo Joe's comments on at least what I can speak about the large financial institutions. I can't speak so much about the smaller regional banks. But the very large financial institutions, following on the heels of Dodd-Frank and the regulatory response, I think, first of all, you know, we needed more regulation. Things were too loose. Leverage got simply too high. Any type of security could be financed at one point in time. And then when that financing went away, the value of those securities were hard to determine, and if not worthless. So the large institutions have significantly more capital. They have liquidity coverage requirements. They have all sorts of things. Have gone through enormously challenging stress tests, as they should. So independent of what an institution may have done on its own in terms of risk management and stress testing its portfolio, the large financial institutions have gone through multiple rounds of prescribed stress testing and have adjusted their business models and their capital liquidity ratios to deal with it. So I feel like the large financial institutions, most of which have actually gotten larger post the financial crisis in terms of balance sheets, are in much, much better shape than they were at the time of the crisis. The capital required to put up against those hard-to-price securities is significantly different, to the point of being almost uneconomic for market makers to support those securities. One of the negative consequences of this, but I think in the long run a positive one, is the traditional market makers, even for Treasury securities, do not hold the same positions, do not provide the same kind of liquidity to support the volatility, the natural volatility in the price of securities. And so as a result, the volatility is amplified as a result, because you don't have someone stepping in to make an orderly price on a particular security, because either they don't have the balance sheet, or it takes too much capital to do so, or it's economically not worthwhile. So I think you're going to see wider ranges of volatility, both in the fixed income and the equity markets, because they are safer and more sound, and they're simply not taking the same positions they once did.
I'd just add, I'm generally feeling like the state of the U.S. economy is surprisingly good, considering everything. So I'm not expecting one of these type of events in the near term. But as we sit here today, I think it's fair to say probably the institutional ability of the country and the political system to address such a crisis is not as good. And I think even some of our prior speakers have commented on the fact that the Fed has used more of its dry powder than it doesn't have as much as it used to have. Maybe it'll get back to having more. The federal balance sheet with the budget deficits is significantly weaker, so its ability to take actions would be limited. And then I think this whole discussion around the political environment, next time this happens, and hopefully it won't be for decades, but somebody's going to have to be gutsy to step up and do what was done last time, because one has seen sort of the political tail on the last time, which has been pretty tough, I think, for people that did take actions.
Yeah. So the one of the examples of we don't have the same ammunition at this point is that you have some central banks that are still kind of at a zero or negative interest rate. In this country, we've had persistently low interest rates for an extended period of time. What are the unintended consequences of that low rate environment?
Well, I think obviously it's had a tremendous impact on the financial markets, and so that's one of the things that's contributed to the significant growth in equity prices, because asset managers who are charged with getting a specific return to fund their pension liabilities or whatever have driven much more into equities because in some cases dividend yields are better than yields on debt. So I think we've had this somewhat perverse effect of maybe goosing the equity markets more than what a more traditional Fed policy would have done. And it seems like we're having, I don't know, more trouble than I would have thought getting out of that low rate position at the Fed.
Yeah. And I think the prolonged low rate environment has hurt the average saver in the United States. You know, whether you're a retiree or saver, middle income, low income, you can't get any return on your deposit. You can't get a return in your money market fund. So you're either forced to live with that or try to put something into equities, which has its own risks associated with it. And so the gap between the haves and the have-nots mathematically is widening. People who have some degree of wealth or income, by definition, have more options, more choices, and therefore can earn a bit more. The have-nots are stuck in a very low rate environment that can't earn anything or virtually nothing on their deposits or money market funds or whatever they're invested in. So it's simple math. It's not a huge surprise. It's a big social problem, an enormous social problem, to see this widening gap. And I think part of it, not all of it, but part of it is a very long, prolonged interest rate environment.
Yeah.
Low interest rate environment.
And it may not change. That's certainly our expectations for some time. But you know, the savers, you know, I've used this phrase with clients, savers are the sacrificial lambs of monetary policy. Part of that is intentional to incite risk-taking, incentivize risk-taking. You know, we have worried about the distortions there, right? The reach for yield and to be more successful to one's, you know, investment objectives. So it's, you know, I do the calculus. It's, you know, but I don't think we're going to get out of this for some time. You know, I think there's a number of structural forces. You know, we told clients, do not expect, say in the United States, interest rates above 3%. I don't know. I'll certainly be retired before. My guess is before we see them. That's not we're not bearish on the economy. We have to understand that there's a great deal of pressures downward on interest rates, not so much upward, unless we would see inflation go crazy. But that's not likely.
How old are you again?
47.
I just wondered, I'm trying to figure out how long until you retire.
At Vanguard,
that means I may not see 3% the rest of my life.
Well, at Vanguard, you can retire at 50. So, you know, I'm cheering the stock market up. So.
Hey, Bill, one other point here, a little bit on your first question, a little on this one. Jim Cox addressed earlier when he talked about, his panel was asked where the risks in the financial system might arise, and he observed that the amount of money that's moved into private capital, whether it's private equity, direct lending, et cetera, has grown quite a bit, and that capital tends to act a little differently than public capital does. It also addresses the issue of, you know, that's generally only available to very sophisticated investors, so it addresses the issue that Gerald was just talking about and Joe. But I think it's another factor that I think about a lot as well.
Yeah. I mean, this is really for the previous panel to address, but it sounds like these persistently low interest rates may explain why we have not seen Wall Street and Main Street make up as much as they could post-financial crisis. Is that a crazy observation, or?
Well, again, I can speak only for the large financial institutions, and we weren't a mortgage lender, didn't really have any role in that. But if you think of the large banks who have paid enormous amounts of fines, and they did a lot of bad things, so it's not without fault. A lot of mortgage modifications and associated with that. As a result, the large banks are making only mortgages to the most qualified individuals. And so those who are not the most qualified individuals are going to non-bank lenders. And as a result, you're going to get, a lot of the securities, once the mortgages are made and the securities are formed, being sponsored by less well-capitalized, less liquid institutions. And so I do worry about that going forward. So you've solved the big banks, but you haven't solved the whole system. And there's evidence, I'm sure somebody's doing some academic research on it now, some of the signs of what was happening back in 2004, 5, 6, 7 are starting to emerge today. Low documentation, low income verification, small down payments, things like that are reoccurring. Now the good news is they're not being put into super leveraged securities, and they're not putting into leveraged securities on top of leveraged securities that then are being financed overnight. So that multiplier effect has been taken out of the equation, but the underlying issue still exists.
So all of you have talked about the critical role of liquidity at every level for the economy. And there's also this reality of the potential for contagion. And so liquidity crisis plus contagion, and you see what we get. Are there some unintended consequences in terms of policies that have put us in a position where liquidity could be an issue that remains, and we know contagion is going to remain?
I think it's your turn to go first.
Yeah,
right,
Joe, it's all yours. You're the big liquidity provider.
We're the big liquidity provider. I think though, I think you have to take a step back. There's a lot of protections, I think, and safeguards in the financial system. Clearly not enough. There was a clear deterioration in lending standards, even regardless of what legislative bodies we currently had in place pre-GFC. I do worry about the amount of capital that is just in the global financial system. It's a sign of increased global wealth. Globalization, those zeros can move very quickly across borders and increasingly across markets. And so, do you have the sort of transparency in place? I'm not as concerned as I would have been 3 or 4 years ago, but it's still one of the factors that keeps us up at night. What you do as an asset manager, twofold. One is you make sure you know who your client is. So you have to have, which goes beyond even a regulation you have to make sure you have a diversified funding base. You have to make sure that you have very prudent risk management. And that's where I have my biggest concerns, because there's always the temptation or incentive to take on greater risk than your peer group to try to outperform. And so that, we have at Vanguard, we generally have, although it's more competitive, we generally have the tailwind of low expense ratio, which means we do not have to take on as much risk in a fixed income fund or a money market fund relative to our competitors. But you're only as good as the whole ecosystem. And again, we are far from perfect. I think there's a lot of sound financial institutions. So I worry about the risk management, the slow, as every day passes from the GFC, the temptation to take on a little more risk. That's what I worry about.
Yeah. The only comment I would make is, given how the U.S. economy has performed positively over the last several years, we're what, Joe, you would know, 9 years into, a quote recovering market, if not bull market. Europe is kind of moving along, albeit slowly. China's growing less quickly, but the economies around the world, with a couple of exceptions, have generally been positive. So the amount of capital and liquidity that has built up over time is quite significant. So I worry less about capital and liquidity as opposed to the riskiness of the counterparties on who's seeking it. Because we go through our risk management process. Joe does it in his, Rick did it in his firm. you can decide tomorrow they're no longer an acceptable counterparty. And it's not weeks when you decide. And so the change of behavior of those capital flows, the change of behavior of that liquidity can be very rapid. And so the only other factor I'd throw into it is most governments around the world, ours is probably close to the top of the list, are issuing more debt than ever before as a percentage of GDP as well, not just absolute levels. And so our current budget that's being proposed, their revenues are up, what, 2%, and expenses are up 7%. I don't know of a business that can last too long operating that way. So you do have sovereign debt that's being issued at very rapid rates. So some of the liquidity is being taken up by funding the sovereign debt.
I have nothing to add on this.
All right. So if we turn to risk management, a key element of risk management is you rely on certain correlations to hedge out the risk. And so Doug Breeden at the start of the day showed a slide that showed the flip in the correlation with 10-year treasuries and corporate bonds, and that was hugely painful. I had Brian Moynihan up on the stage not that long ago, and he talked about how the housing crisis was largely because the assumption was that there would be movement both up and down across the country, but you wouldn't have all prices correlated, and we saw all prices become correlated in terms of the drop. So Joe, they like to pick on you in terms of, as the chief economist, what kinds of correlations have you been thinking about that you go, wow, that if that changed, we'd be in trouble, or this could change? I mean, is that something that you're considering?
We actually think about it a lot, both from an active management standpoint, because you want to look at your different risk exposures. Think of a fixed income fund, you're trying to beat a benchmark. And so, that correlation between corporates and, say, treasuries matters dramatically. And we also look at this, obviously, for global asset allocation for long-term investors or shorter-term ones, where you have equities and fixed income and other instruments, including private. Many institutions we may consult for have private assets as well. So what we do is we try to be, my group does all that modeling. I see we have two broad principles. One is use as much historical data as you can get your hands on. And secondly is to make sure that the distribution that we pull from, because we'll use a lot of math but informed by history, is make sure that that distribution is wider than whatever we have observed historically, because things that could have always been both better and worse, despite what we've seen in history. And then the third one is to effectively what we do is to model effectively in, I would call them average states, and then stress states. And so that doesn't mean we'll get exactly right the probabilities or you get two different outcomes from an active strategy or an asset allocation strategy, depending upon how much you care about stress states. So we will use what's even, for those mathematically inclined, Markov transitioning matrices to actually assess those two different states. It's part of our risk management software and systems. Now, again, the art and judgment comes in as to how much you're going to weigh that state. If you think there's always a 99% probability that we're going to jump into a crisis state tomorrow, you will never take any risk. And so we will all be in treasury bills, even for long-term investors, which would be imprudent. And so that's where the art comes in. Also acknowledging that despite all the math and finance and big data that we bring to bear, that we have limited information, and so to treat this with humility. And so again, I think that's where the human judgment comes in. But again, very mathematical treatment of it, and to assess that the tails are generally wider than you think, and they're generally, the probability of going into a fat tail state is highest when volatility is lowest.
I couldn't agree more.
Well, I'd just add this. We had a conversation Dr. Fudd was talking about this morning, but the general sophistication on your average board in the matter of risk management is 5, 10, 100x what it was, in my view, 10 years ago. Yeah. And it's because people who have always been smart on boards are thinking about the topic a lot more. And so I agree with Joe. I don't think you necessarily can foresee every potential, kind of black swan scenario, but I think you have more smart people thinking about it at the board level, challenging management. So management's really working, and they're getting high quality people in this, and it's a respected corporate function. If not always well embraced and loved, it's respected. And so I do think that is something that's significantly different than 10 years ago or 15 years ago.
The one thing I would add that we didn't think about as much 10 years ago was the contagion effect. That, if you accepted XYZ institution as your counterparty and you thought that they were fine, you didn't necessarily think about who was their counterparty and the subsequent counterparty and the subsequent counterparty, because for every side of a trade, there's two parties. And John Mack talked this morning about trying to be in a neutral position. So you have a lot of long positions, you have a bunch of short positions. Well, there's somebody on every side of that trade. And so I don't think we thought nearly as carefully about the contagion effect. And I think it's ultimately why, the Fed and Treasury decided to support AIG and not Lehman Brothers, was the contagion effect of AIG was staggering. And it wasn't just Morgan Stanley and Goldman Sachs, it was many other institutions all around the world. And so I think there's a lot more thought put into the contagion effect. If one counterparty goes down, what's the effect on other counterparties, and what will that look like over that fat tail risk?
Yeah.
Okay. So I think it was Bernanke who said that recoveries never die a natural death, they get killed. And so we've been in extended recovery. We're supposed to get to, could it happen again? Let's start with recession and how prepared we are to cope with a recession, which, in your expert opinions, if the trade war activity accelerates or if we have a hard Brexit, how vulnerable are we to entering into recession fairly rapidly?
Gotta go to the guy
Get that one.
who studies it.
Yeah, that's I guess my job title. I should be able to answer this one. So we still maintain that the odds are elevated, but not close to 50%, both in the U.S. as well as most of the leading economies of the world. So our theme this year, if you had to boil the global outlook in one phrase, was down but not out, which is a play on a boxing analogy that, now I'm from the city of Philadelphia, so if you've ever seen the boxing movie Rocky, right? If most of the movies Rocky wins, but he doesn't look like he actually won. He looks pretty beat up. So, and I use that because that's how it'll feel, and I think we will be in for choppy waters. But something has to get material worse. The trade war is by far the leading risk factor we have had. The Fed was a close second last year in terms of them being more emboldened to continue to raise rates, but we at the beginning of the year, we removed that. In fact, I think that risk has been eradicated. In fact, it's just on the wire 2 hours ago. No more hikes this year. Right. So I think that's good news. But the China slowdown is worse than reported, and it's worse than expected, and policymakers are not ahead of the curve. I just came back from China as well. I can tell you firsthand and secondhand that is indeed the case. Now, the trade war came in on top of an intentional slowing of China's economy. So I'm not here to pick on China's economy. It's just that's where the source of weakness has consistently been, which has been a primary source of Europe's weakness. So we're not out of the woods yet, but if we're right, we should see some stabilization from China's economy. It will leave a modest imprint on the U.S., certainly some on Europe, but it's enough where it's a modest low growth environment, but it's not recessionary, so it could be worse. So if it's not down but not out, the other tagline would be it could be worse, which that would be the outlook this year.
Yeah. Okay. I think Europe is more challenged. Yep. Their economies are slower. They have a high dependency on exports. China and the U.S. being the principal buyers of their products, other countries as well. They have still a negative rate environment, negative interest rate environment. Their financial institutions are not nearly as healthy as the U.S. ones. They didn't take the pain and the medicine as swiftly as the U.S. institutions have done. And so I think there's still some creakiness around their economy and their financial system, but nothing that I can see points to a crisis as opposed to a slowdown or a modest recession.
I think it may be worthwhile just saying from the U.S. side, and particularly industrial sector, auto sector, never fun to go through a down cycle. I think the sector is, with an asterisk I'll give you in a second, a better set to do that now. Labor agreements have been significantly restructured, capacity utilization is higher, more of the cost has been switched to fixed or variable from fixed. So I think they would go through better. The asterisk is coming out of '09, a lot of suppliers went through bankruptcy, were purchased by private equity firms, are very heavily levered now. So I think that'd be something that we'd want to watch. But I think the state of the structural cost state of the industry is better. And I suspect that's true in many other, certainly at least industrial parts of the economy.
And so if we do enter into recessionary territory, it sounds like none of you feel like that becomes a trapping state and that leads to more of a crisis situation where we can't pull out. So we're still well positioned to deal with a recession in your views?
Well, some sectors will be hit harder than others. Credit markets will, by definition become much more volatile. There will be pain. No recession is not without pain. I just don't see it being nearly as severe.
I mean, we'll very likely when we have it in the United States, because we're unlikely to get above 3% on the Fed funds rate for some time. What we have is when we do our risk management scenarios, and when we hit that negative state, is more likely than not the Federal Reserve has hit the zero bound. We would see extended forward guidance, more quantitative easing. We would probably see the introduction of LTROs like we've seen in Europe if things got really bad. And that's where, Sarah was talking a little about it earlier this morning. The one who I would have concern. Listen, I think it's always risky to undercount or to discount the resiliency of the U.S. economy. Also, I don't know what it is, but the natural inclination to take on risk. I think that can get you into trouble, clearly, but it can also be a benefit. And we haven't seen that dynamic in every country around the world. Japan, there's a number of reasons why Japan is still stuck today. That is one of them, not the only one, but that is, in my judgment, one. And so I think what would concern me is that we could be under a very low or L-shaped sort of recovery should we get that negative shock or two, Bill, for some time, and there may be the lack of appetite should the economy require more fiscal stimulus, the reluctance to do so or to drag one's feet on it. Again, if conditions really warranted it. So it's not so much that we would experience another financial crisis in the near term, very unlikely in my judgment. It's much more of you could be, much like Europe, I think they are falling into what some would call a significant risk of secular stagnation. And so you just you bounce along this very low growth environment. I just don't see that as a high likelihood in the United States, given some of the other things, some of which I'll just chalk up to intangibles, for lack of a better term. But that's the risk I worry about.
I would just add to that I would say probably corporate America is a little out of shape for a world that's marked by trade wars, because we've had we've been on a quote good trend on that for 50 years. And so if a number of these broke out, for example, if we didn't get a NAFTA continuance or replacement or something, there's a lot of stuff that needs to be rethought. And I could imagine the first thing you do as a company, you might stop and say, stop, we're going to figure this out, don't spend here and there. So you could get perhaps a little harder hit in the hit on the economy if that played out more broadly. I don't personally think that's the likely case, but if you want to worry about something, I think that's a good thing. If I were running a big company right now, I'd be running some scenarios and really try to think about that beyond the first degree order, first order impact.
Yeah. Okay. And just to follow on to that, because what Rick mentioned, that's exactly how we try, because as an economist, our job is to assess the probability of distribution of risk for assets and for the economy. But then the question is, how do you quantify uncertainty, which almost by definition is unquantifiable. But there's a really good, came out of academic research. If you ever want to look at in real time what we look at of all the modeling we do, one of the variables we've been tracking a lot gets to trade war is policy uncertainty. There's actually a measure that looks at the word mention uncertainty through Google web searches and press citations using big data techniques. And you can go to policyuncertainty.com, give you some of the trade secrets, and that line in China broke out 6x last year. That immediately when that happened, I can tell you what our econometric models did. We dropped our projections. Financial conditions are another important one. So in the US, those two are offsetting, but that's where I worry about trade war. What should we not get clarity? Regardless of what the outcome is, we don't get clarity, we will see further stalls in business investment, and that could lead to this mild recession. It's that uncertainty, because that is becoming more mentioned in corporate.
Yeah, what business and corporate America hates is uncertainty.
Yep.
It could be a bad trade deal, but if they know what it is, then you adjust accordingly.
Yeah.
One other angle on this, so if we have a normal recession, you'd say no problem, we live with that. But I think about sectors that are under disruption like the auto sector is right now. If you go in spending a lot of money on how to bring autonomous driving to the market, which is a very difficult and very expensive proposition. If you go into a down cycle, they're going to have to relook at how much they can spend in that space. Not a big deal for the next 5 years, but if in an industry that's structurally changing, if you can't invest what you want today and tomorrow, it can come back to bite you in 10 years or something. So, I think that is something that, depending on the industry you're thinking about, it might not be so bad today or the next 3 years, but it could have ramifications for you down the road, which would be important to think through.
Yeah. But my sense is, from listening to the three of you, that you're relatively optimistic or bullish about the U.S. economy from a structural perspective, from an intangible perspective, and so that if we face recessions, we'll get through it. It'll be painful, but we'll get through it. So let's turn to crisis, which unfortunately, the reason why we have crises is that something unexpected happened. And so if we knew what was going to happen, then it wouldn't be a crisis. Having said that, I'm going to let each of you give your scenarios, your crisis scenarios, that we would not be prepared to handle, and then I'm going to turn it over to the audience for questions.
Oh, jeez.
So,
you're more current than us, Joe.
I think it's better to go first, because you can get the obvious ones, and then you guys I think that the toughest one would be a geopolitical. I mean, if for some reason something, again, I do not expect this to happen, but broke out between the US and China, which was just more than trade war sparring, but got into something bigger, I think it'd be hard for people to really think through the full-scale ramifications of that. So something like that, maybe, if we misread North Korea and something like that, I think that could really shock people. And as I said, the fact that we've kind of drawn down the account at the Fed and the federal budget and stuff like that, I think that might expose that in a more unfavorable way even than we might be thinking about.
And I would say the inherent potential market volatility, again, both fixed income and equities, is greater today than it was in the past. And I, by the way, I happen to be a big believer in index funds and ETFs. But index funds and ETFs, by definition, have to buy what the market calls for. So if you have a rising market, you buy into it. You have a falling market, you have to sell into it. And so that in and of itself creates a wider range of volatility, which, back to the falling knife scenario, which I'm not suggesting, if you're in a downturn and you have to keep selling into a downturn with so much money invested in index funds or ETFs, it could cause more disruption than we may think about. And investors don't like losing money, particularly rapidly, and that can cause other social and other regulatory congressional responses, which may not always be good. So I do worry about that a little bit.
Yeah, and I think, I'll get to my 2 points. The one point that we tried to mention to policymakers and regulators, something I think maybe, so there are some ETFs I know in particular, particularly those that have leverage, embedded 2 and 3x.
Oh, yeah.
Okay.
Yep.
Whatever. But the one thing that we
It's
try
like
to
CDO squared.
Yes, well, why? How about 10 times leverage?
Yeah, why not? If 10's good, why not 20?
More is better. But what we try to say, and this doesn't in any way, eradicate entirely those concerns that Gerald has, but you know who the largest purchaser of, so we have our largest funds are, say, total stock market index fund, one massive fund. You know what the largest purchaser of that is in the down market? Our total bond fund.
Yeah.
Why? Is because our target date funds are fixed to an asset allocation. So when the stock value is going down, we have to buy more stocks. And so some money going from the bonds or going to stocks and vice versa. So it doesn't completely offset the volatility, but it helps to, I think, moderate that. And it's something actually we've talked to policymakers in Europe as well as even in China, because that can be, it does not eliminate financial market volatility. I'm not that naive, but that's, I think, an important offset. I'd say, the two things I worry about, again, global financial crisis. So that's more significant than a recession, a bear market. We're talking about a multi-year, if not decade, build up in asset values and credit and leverage. And that credit and leverage sometimes grows at a faster pace than the asset values. And so what environment, and then that obviously leads to a bust. And so what are the two areas that I think could be the next areas for financial crisis? One, I worry about China. Now, in one sense, they are still in many ways not tied to the global financial ecosystem and the fixing of the renminbi. And I think that in one sense reduces the risk of global contagion, but the opaqueness of the debt markets. It's now the third quickly to become the second largest debt market in the world. So I do worry about that, not only because it's tough to get the handle on it, but having been to China, seeing significant progress and more financial disclosure. So I think that's good. I think if there's a risk to China, it becomes the next Japan, not that it becomes the source of a global financial crisis. The secondly is, and this would be also partly good, it would be, like any financial crisis, they tend to be tied to an asset and or financial innovation that is by definition new. So hence the belief of not only high explosive growth, which is why, many people are smart. It's like everyone's, maybe ultimately ex post we can say everyone was fooled and should not have thought home prices were going up, but there was a lot of strong fundamentals for multiple years. So you're seeing home prices go up. And so what is that next asset that does that? I think things, I don't know, effectively then you have to call the next, if you're going to call the next financial crisis, one has to then call the next bubble. And so then to call the next bubble, it's going to be, I don't know. Anyone's guess here in the audience is as good as mine. I would, if you're asking me, I guess you are.
I am.
Well, I'm asking myself now. I would put it on machine learning and artificial intelligence and AI. And so I don't know what that is, but that asset values would have to be tied. No, that's long term because we're just talking about this stuff. But if you would match that with credit provisioning, though, it's not just asset values, with credit provisioning, then that would be, but that would have to be, I guess that's probably over a decade, 15 years away. Now the good news could be is that we would have another 15 years of expansion. We're only mid-cycle, and so this 10-year recovery is only halfway there. So we have at least another good 10 years to look forward to before the bottom falls out. That's a good news. Yeah, that's a good news story.
So on that positive note, any questions from the audience? Doug?
Well, I wonder if you worry about financial terrorism or kind of computer.
When we, for our board and regulators, et cetera, we don't talk about this too much publicly. The number one risk is cybersecurity.
I'm on a private company board. Letter from the CEO or urgent email that one of the primary competitors had an attack, completely disrupted their business, and they're concerned, obviously, that, so yeah, this is huge. Thanks for bringing it up.
Yes. Yeah.
Ruined our night, but it's good to have it.
Yeah. See, yeah.
I have a question related to the private markets and how money has increased there. So with BNY, my thought when I hear BNY is fund administration. And so is that an area of business that grew for you and kind of you benefited kind of shifting some of those services you offer and how the services you offer changed? And then just any other thoughts on how you think the private capital helped us out of the recession as a resource for those suppliers on GM for getting a loan when banks wouldn't give them.
Yeah. Well, certainly the growth of the, quote, private market, and the private market could be asset managers, it could be, you know, special purpose corporations, although most of those have gone away, thankfully. The amount of funding that's done in the, quote, private market versus the traditional banks or investment banks continues to increase. You know, I mentioned earlier that, you know, mortgages, the greatest percentage of mortgages are actually being underwritten by non-bank financials institutions or the private marketplace. Most of the leveraged lending that's done for private equity firms buying other firms is done in the private marketplace. It's not done by the financial institutions. The Federal Reserve actually put caps on how much banks, the large banks in particular, could lend against debt to cash flow, or how much they could have in the aggregate in their portfolio. So there were actual limits put on financial institutions in making the, quote, riskier loans. So the capacity's been, or the demand's been taken up by, quote, the private marketplace. And you continue to see private equity firms grow substantially in importance. I think it was CalPERS or CalSTRS recently said they're going to significantly increase their allocation of their portfolio to the private equity marketplace. So you're having pension funds move more of their assets into the, quote, private arena. And so the one concern you have as a result is now you've got the large banks highly regulated, very prescriptively, but now you have a big marketplace that is essentially not totally unregulated, but pretty free to operate. So that is a concern. And so at the Bank of New York Mellon, what we did was, you know, we're agnostic, we're Switzerland. We provide services to the private equity folks, to, you know, the hedge funds, to every aspect of the market, not just the mainstream financial institutions.
I would say as far as the advantages of being, or there are circumstances where I think it's helpful to be privately owned. And in my experience, and I generally am on a few public boards and a few private boards, the private boards, the management is focused solely on running the business and delivering the results, and they get sometimes more help than they want, but they get help from the private equity investor, the lead investor. And you know, you have the advantage of you don't have all the disclosure around things. If you've got a particular technology initiative, you know, you don't have to disclose as much as you would in public documents. And frankly, running the company is simpler. You don't have the filings, you don't have the SOX requirements. So I think in some cases it makes a lot of sense. You know, usually everybody wants to grow up and be a public company, so you know that's sort of what people tend to drive to. But there's more and more. I mean, I see now the classes of companies that get sold from a small PE firm to a mid to a large, and so that's, I don't know. To me, that's a relatively recent development over the last 10 years, and so it may just be the point that some companies are just better suited to be privately held in those structures. So I don't imply any negative connotation to it, but it is different than a publicly held security for sure.
Okay, well, we've run out of time, so I want to thank three tremendous panelists for their insightful remarks.